As we look at this DOM, this is real-time hours for a faster moving market, a market that moves more than one tick at a time when it moves. In the top right hand corner is the correlation. In these sorts of markets, more real-time hours, the correlation doesn't often or usually give you a heads up, but it can still confirm which direction you want to trade with. As we start this recording, we can see that the current market price is 35 bid offered at 40 and the correlation is plus 13. It looks like at the moment the trader has been thinking about placing a bid. If we just start to look at it now, so we can see the market just drops. This is quite typical of a faster market. The correlation, which was plus 13, has dropped to plus 11. So clear signs that value is falling. So the trader would want to trade from the short side. We were trading 35.40 before, so the trader would be thinking about placing a short where we've just come from. Current price 25, so that's where we would see value right now. Indeed, the trader does go and place an offer at 40, which is where we were just trading. The last price is 30, so that's where value is, so we'd still be selling above value. And notice you'd want to pull in at least a couple of ticks of edge in a faster market. 20 is the last print, so that's where value is. The trader gives it a couple of seconds. If the trade isn't filled, it's pulled. Trader goes back in now, still likes the trade, correlation still ticking down. So this is a new trade, pulled the original one to trade by selling at 35. Last print is 25. So selling at 35 would still be a couple of ticks above value. Notice here the spread has widened 25-35. Traders at the moment has stayed on the 35 offer. Now remembering that the spread is our edge, a 2-tick spread like this means that a trader has more edge. So whereas if you're a trader that puts in market orders, the wider the spread, the more you get hurt. If you use the spread, like Norton method traders should use the spread, then a widening of the spread actually gives us more opportunity, more edge. Traders immediately filled there on the 35 offer. Notice how it quickly printed 40. You're never going to judge, or not often or always going to judge exactly the top of where the sweeps are. So it printed 40 quickly, but notice it's come straight back, and that's a classic situation. So if it prints through you and stays through you, you would want to exit the trade. In this instance, it printed 1 tick through the trader to 40s, but immediately came back. The traders put a 25 bid in and gets filled very quickly. If we actually just go back a few seconds and look at that in real time, here's the trade exit, 25 bid, filled within a couple of seconds. So in a faster market, the trade can go through you sometimes. You're not always going to get the edge of the sweep. The trader had built in 2 ticks of edge, and in this instance was able to make 2 ticks. And notice that even though it had gone through him, it came back on side very quickly, and that's the key thing. If it had printed 40 and stayed 40 for a second or so, or stayed 35.40, the trader would immediately try to initially scratch that trade. So there we saw value, we saw the correlation fall, we saw the market fall. With the market printing 20 and 25, the trader sold 35s, which had 2 ticks of edge, which he took.